market strategist at Morningstar, and he joins us now, as you can see. David, thanks a lot for joining us. What will you be looking for in those Nvidia results coming later today?
Well, there's going to be a couple things that we're looking for, both in the short term and the long term. Although I have to say, right now, the stock looks pretty fairly valued to us. Our analytical team has a $130 fair value estimate on the stock, puts it right in the middle of that 3-star territory. But of course, as you mentioned, as Nvidia goes the rest of the AI stocks, and goes really the rest of the market, for that matter. So in the short term, it's all going to be about, how much did they beat by, what is guidance, versus the whisper numbers. At this point, we really don't foresee the company surprising anywhere near with the same kind of magnitude of upside surprises as we saw, over the past, year to year and a half. But really, for long-term investors, I think it's, much more important to focus on the underlying dynamics and fundamentals, as opposed to whether they, beat or miss, by a couple pennies, here and there. So realistically, we're going to be listening for any change to the underlying fundamentals, really listening for the data center growth trends, as far as the rest of the hyperscalers, they all still told us, over the past quarter, they're still looking to increase spending on AI and GPUs by 30 to 35%. But our team also wants to hear, how are those GPUs actually being used? Things like how much of it is being used for training versus inference. But overall, for 2026, for the fiscal year, our revenue forecast is currently $195.5 billion. That would be up 5% from this prior year. And we're looking for earnings of $4.35 a share, puts the stock at 30 times a forward PE, which we think is pretty reasonable for this situation. And then even looking forward from there, our fiscal 27 revenue forecast is up 21% to $236 billion, and we'd be looking for earnings in 27 at $5.18 a share, putting the stock at 25 times 2027 earnings.
How important is the substantial capex that the hyperscalers, companies like Microsoft, Meta Platforms, Alphabet / Google and Amazon, that substantial capex spend that they're devoting to these chips? You mentioned it, and one of my earlier guests today mentioned the very same thing, saying it's almost a leading indicator of what we might expect in the Nvidia results. How important is that robust capex?
Well, it's very important, not only for this year, but really trying to understand what that capex spending is going to be over the next, 2, 3, even over the next, 5 years. Now, generally, when I look at AI, in our 2025 U.S. market outlook, we kind of ask the rhetorical question: is the AI trade over? And really, what we've seen is that, stocks most closely correlated to AI were pretty fully valued, if not overvalued, coming into the year. And what we've seen since the DeepSeek, scare a month ago, a lot of those hardware stocks have really sold off, whether it's ARM, Broadcom, Taiwan Semi. Some of these stocks are in correction territory. Arista and Marvell are both down about 20%. In fact, we think Arista probably still has further to fall. ARM, one of the more overvalued stocks in our coverage. It's a 1-star rated stock. It's almost double our fair value. And really, when I look at a lot of these hardware stocks, most of them are pretty fully valued here. The only one we see much value left is going to be in Taiwan Semi. That's a 4-star rated stock at a 30% discount. So really, I think this year, we're going to see the evolution in investing in AI, moving away from the hardware providers, those stocks that have been, the big market movers over the past, 18 to 24 months, and looking for those companies that will be able to utilize AI, whether that's to improve their products and services to drive revenue growth, and or be able to incorporate it within their own businesses to be able to drive efficiency, get higher operating margins. So 2 stocks that we see as early indicators there are going to be Microsoft and Alphabet. Both are 4-star rated stocks, trading at 19% and 26% discounts respectively.
I've read some of your recent commentary on the markets more broadly. We'll set aside Nvidia and the AI stocks for now. On the market more broadly, the S&P 500 is now up 2% so far this early 2025. You say you think that markets are trading at a slight premium to your fair value estimates. You remain market weight in terms of equity market exposure, but are increasingly cautious, and you like high dividend paying stocks right now. Explain that to us.
Yeah, when I look in the market overall, as you noted, we do think it's trading at a slight premium to our fair value, not anywhere near the point that I would look to underweight stocks, but I think positioning this year is going to be increasingly important. And a big reason for that is the tailwinds that propelled stocks, last year, a lot of those are now definitely slowing. So for example, monetary policy is easing here in the US, that is slowing as well. I think the market's not pricing in another rate cut until June. Inflation, which had been coming down, has been pretty sticky the past couple of months, and we're seeing a bounce in interest rates, or an improvement in interest rates this year, but they have been climbing for the past couple months. And of course, we're looking for the rate of economic growth in the U.S. to slow over the next couple of quarters. So that is a big reason why I like high dividend paying stocks right now. Overall, I expect a little price appreciation in the market at the index level. I think we need to have earnings catch up to valuations. That's probably not until the second half of this year, at best. So for now, I think you can get paid while you wait in those high dividend stocks, and generally those high dividend stocks are going to be in the value category where we see much better value, whereas we think growth stocks as a category are significantly overvalued here.
David, thank you so much for this conversation.